To start off the show with a uh, conversation about kind of what was happening in the market today, or this week, sorry. I had looked at a chart, a 5 minute chart at this week. It was looked like an EKG,
Yeah.
and like a 100 point swing actually between 5,600 and 5,700. Just because there's a lot of things going on. There's good news that's happening. We had a decent, jobs report on private payroll, decent, report on housing. We've got, the Federal Reserve came out and said that, the economy's good as far as they're seeing it, but they want to wait and see what's going to happen. The dot plot, which is what comes out 4 times a year, each quarter. The last one was done in December. It's where all the Fed governors get to say, hey, this is where we think, the rates will be at the end of this year, at the end of next year, et cetera. And it changed slightly. The dot plot, in my opinion, if you look at them closely between December and March, the consensus guesstimate for where inflation would be went up slightly by the end of this year, but not a lot. The number of cuts is still expected at 2 cuts for this year, which is the same thing that we saw, in December. So that hasn't changed. The market did get to a point, and there's still more than 2 cuts. They're up to 4 cuts, expected. And so, all of that stuff has to be factored in, and kind of the volatility comes in. Of course, the tariffs, honestly, there was a little bit less tariff information this week than normal, but normal has been so crazy in terms of what's been happening. April 2nd is coming up, and that's the time frame that people will be focused on as far as that goes. And so I think one of the things that we have to kind of watch for here is, again, actually, let me go a little bit farther with the perspective. Let's take away the weekly summary things. It's a little hard to see this anyway, but this is going back to 1994. And so I think one of the things that's happening, this is a news feeding cycle. There's a lot of interesting stuff to write about, and Social Security, and the data. Is it safe? The whole concepts, around tariffs and all of these things. It's just in deportations. I mean, just this is a feeding frenzy, and I think it's being absorbed by a lot of our clients, and some of it's been some fear is coming into play there. And that translates to kind of how you're looking at the market. We did have the fifth fastest 10% drop in the last 75 years. But the key thing there, at least so far, is the fact that it is 10%, which is essentially an annual event for
I think
all
it was
intents and purposes.
I think 10% corrections happen every 1.2 years since
Yeah.
1980.
Yeah, and so here's going back to 94. So if you look at that steep rise we had, that was really fun. From 95 to 2000, that's the best 5 years in the history of the stock market. Created a situation where the market was very overvalued. We dropped 45%. And then the market came right back and actually got right back up to that high, slightly higher. And then we ended up at the 2008 downturn because of all the mortgages that were sold to people that couldn't afford to pay those mortgages. And then the insurance policies on top of that. The big steep part of that drop there that looks like a straight cliff is when Lehman Brothers failed because of those policies, insurance policies sitting on top of these mortgages. So that was a 57% drop, okay? And so all of those started with a 10% drop at some point in time. We see the pandemic, that little spike that's straight over my head there. That's the fastest 35% drop in history. It's the same type of thing we're dealing with now. It's just like, what is this? And how does this really impact things? And, how does a tariff really impact the economy? We have some examples. We have 2018 where the stock market dropped 19.6%, but it came back pretty quickly. It obviously didn't affect things dramatically because the market continued to do quite well, actually, after that. The pandemic had a bigger impact. Ironically, it actually had a bigger impact on the upside for the stock market than the downside. That 35% drop was a big deal, but the recovery that we made to get that money back and then some. If you look, that's another very steep climb right out of that pandemic. And again, that was because they forced so much money out, and probably too much. And so we end up with the next downturn that's just right over between us here, which was 2022. That was 28%. So these are real downturns. These are the big ones. These are the things that are happening. we don't know that we're dealing with that at this point in time. And we are seeing things that are in the market that are still making positive rates of return. There are things that are making more money, or, healthcare, energy, for example, is still positive for the week, even though the market's down a little bit for the week. We'll see where this ends up by the end. But, so again, and we're heading into, I keep talking about this, seasonality is actually a pretty big deal. It has to do with basically cash flow that comes into the market. So April's, tied with November for the best month going back to 2004, right? And that one's really obvious because this is a time frame that people focused on their money because they have to do their taxes. And so people do their contributions to their IRAs, or even, hey, we've been accumulated money. We see a lot of money coming in that time frame just because it's the time of the year. And so you're going to have this kind of offsetting situation where, the market dropped 10%. There's some dip buying that's definitely happened here, and we've seen a little bit of jump off of that. But also we've got all of this cash flow coming into, some of it's, coming into managers' hands, and some of them might sit on it or not. But we are seeing, some of that money come back towards us. And so again, you got to be careful of like selling out here, basically because we are heading into what could be a good seasonal time frame. So. And I think the key altogether here is, and this is one of the more important components of how you would think about investing. If you just keep telling yourself that you don't actually know, and matter of fact, nobody actually knows, and we all see these experts talking about, recession. Those guys were out there in 2023 in droves. I mean, I can't remember a time where there were more articles about a recession that was going to happen in 2023. We ended up with a 26% upturn in the market and a really strong economy and a really low unemployment. They were so far wrong. It was ridiculous. So I think that's what we have to keep remembering. And I have to remind myself all the time, too, is they don't really know. We all say, hey, tariffs are going to cause inflation. Tariffs are going to, and that might create a situation where, the market comes down. Like the last time we had inflation here in 2022, the market dropped 28%. We don't know that. We don't know, first of all, if we're even going to have tariffs. We don't know if we do have tariffs, how long they might last. And we don't know, even if they last for a long time, what type of economic impact they might have. Because you do have to consider that we're looking at the S&P 500 here. There's 500 stocks, but it is weighted. So how much of that stock gets input into the motion of the S&P 500 has to do with the size of that company. So you've got your Apples, your Nvidias, your Microsofts, your Amazons, et cetera, that are huge companies, and they are the main drivers of the S&P 500. But even if you took the top 50, you're probably getting a majority of the drive. So it's based on earnings. For those top 50 companies, what do tariffs do, right? So if there's some small company that makes something that has an increase in price, and their earnings go down, it won't affect the stock market unless, there's a broad-based recession or high inflation that comes across the board. So if small areas start to inflate, that probably won't be enough for the Federal Reserve to really, be moving strongly towards, raising rates, which often brings down the market. So again, I can make arguments that these things will be kind of a nothing, burger, so to speak, on the economy. I can make arguments that this could be one of the most disastrous thing on the economy at the same time. And it just goes to show you that we just don't really know. And so you kind of watch what's going on with the market. And again, you look closely. There are, as I mentioned, still things that are making more than T-bills and CDs and money markets and savings accounts. So you should stay in there because if things do turn around, sometimes they can go violently upward, right? And nothing, that is more obvious to me than just the summer. So July, I think 16th, we hit a peak of 2023, and by October 27th, we hit a low, right, down a little bit more than 10% in that time frame in 2023. And then the market turned around, and in November of 2023, again, one of the best months of the year, seasonality, but it was up 8.9% for the month. And it was up about 5% in that first week. That's a lot more money than you can make in your T-bills and those types of things. And you kind of need to be in there to kind of create that growth in your assets so that if we do have a real downturn, like we saw in 2000, 2008, you're not going to see those coming. So you might see part of them, and get out at some point in time, but you're going to suffer some losses. So it means you got to make money when the market does go up, and you kind of need to hang in there. If you feel like you're really out there at risk, then you probably have the wrong portfolio. You probably have too much stock and not enough bond, or maybe not enough emergency of money, And so you can answer those in different ways. You should try to stick with it, especially with a 10% downturn. I can't remember a time where we ever, really made massive changes to move into super conservative things like T-bills after a 10% downturn. There's just too many of them. I mean, you'd be doing that every 1.2 years since 1980. You're not going to make any money. The average rate of return for individual investors via the Fidelity survey is ridiculously low. And part of that is because people keep overreading what's happening. And in my opinion, they're trying to guess what's going to happen, right? And it's very, very difficult because a lot of times, again, press is, inflation's going to be caused, all these things are going to happen from tariffs. Okay, but they might be wrong, right? And so they don't know either. It gets lots of clicks, gets lots of headlines. So, and so anyway, that's kind of the summary for this week. It's actually been a couple weeks now where we've been holding in on that 10% downturn. We did have one thing happen this week. There's a pattern out there that I think is pretty strong. When you get 2 up days, we had 2 up days, Monday and Tuesday, then you often get a down day on the third day, as long as you don't set a new low, which we did not. You'll often kind of bounce off of that. We haven't bounced much off of that, but
it's kind of holding.
Yeah, it's at least holding in this environment. I do think it's tough for the market to really go skyrocketing here because of the uncertainty of the tariffs. Again, you could make a whole spectrum of arguments about what's going to happen there, right?
Yeah,
as far as that goes.
But I think a general consensus right now is the upside's kind of capped as long as there's uncertainty.
Yes, exactly, and we're sort of seeing that. But uncertainty can be resolved quickly, so you can't kind of hang in there. I do think the market is going to be looking at the entire package here in terms of, all of the pieces, the deregulation, the tax cuts, to go with the things that the market is a bit worried about. And, you're going to get people that are coming in and buying at this point in time, and that's supporting the market too. We'll see what happens because, again, right now, everybody's guessing. We don't have any numbers. Matter of fact, all the numbers we're seeing are okay. The job report's okay. The inflation report, okay. I mean, CPI came down. PCE's coming out next week. It's expected to go up a little bit.
Yeah, we've been seeing a lot of outlooks or sentiment. So it's for future projecting, I would say.
Yeah, all of it.
Where rather than actual action or raw data.
Yeah, but the press is treating that like it's actual data. Like, hey, we're going to go into recession because the consumers answered a survey in a negative manner. You couldn't be farther from the truth with that. In my experience, I've seen so many negative consumer sentiment surveys come out. I don't even know why they bother, to be honest, because they have very little correlation with the economy or the stock market. And then you'll see the next reports that come out that show the actual spending, and they're out spending away. They're doing what they need to do to support the economy as far as that goes. And so, the Fed does have one part of those surveys that they are very concerned about. And I'm sure they know what they're talking about, but that is the expectation for inflation. And so if a group of people decide that inflation is going to get higher, in the future, it kind of affects their buying patterns. They'll tend to buy more now, which then could create shortages in some areas. And you could then kind of have a self-fulfilling prophecy, so to speak. And so we have had a big jump in expected inflation, mainly because of the news around tariffs and what might happen. And the Federal Reserve, of course, met this week, and we'll see the minutes. But the last time, we saw the minutes from January, they were talking about the tariffs, and they have the same concerns that everybody else does. They don't know what they're really going to do. They want to wait and see. That's kind of where everybody is right now. It's just, and I know that's kind of a repetitive thing that we're talking about, but it's kind of interesting as far as that goes. But so that's our summary for the week. Glad that everybody was able to join us for that. And again, hang in there. So far, we're okay, right? We're 10% off of an all-time high for a market that has been really, really great over a long time, over a lot of years, and so, think about how things might impact earnings. You can see where the earnings could be impacted for some of these big companies, but you're probably talking about a much more broad downturn because a lot of these tariff things are going to be more company specific. So if automobile manufacturers start to struggle, they're not a big component of the S&P 500 per se, not like the Microsofts and Amazons and those types of things. If, on the other hand, we have all these layoffs and all these things, and all of a sudden there's a lot less spending, consumer spending is 2/3 of the economy, and we end up in a recession because of that, that would affect all these big companies, right? There's just less money out there, less money being spent, people are being more conservative. We are seeing savings rates going up right now a bit too, so there are some people pulling back. We had a great economy. It gives us room to have some hiccups here. And we have not gotten past the momentum that we already had built up. We still have that momentum. That could change, but at least we had it. And that was one of my points at the beginning of this whole thing. If we were in the middle of the 2008 downturn and you start throwing in all these things, you're going to have a hard time, but we're not. We're on solid footing, and so we could continue on that footing for quite some time. If things go just right, or we won't, but we need to kind of see what's going on to really make that determination. All right, so anyway, that's our summary for the week. Look forward to being able to talk to you again about it next week.